What's going on, everyone? It's Pablo, and welcome back to my channel. Today, we're diving deep into a topic that can save you thousands of dollars as a small business owner investing in real estate tax strategies. That's right, we're talking about the nitty-gritty of taxes, but don't worry, I'll make it as painless as possible. Listen, I can't stress enough how important it is to be smart about your taxes, especially when you're dealing with real estate. The more you know about deductions, loopholes, and all those tax code secrets, the more money you keep in your pocket. And who doesn't love keeping more of their hard-earned cash? We're going to cover the top 10 tax strategies for 2024 that every small business owner needs to know. Whether you're just starting out or you've been in the game for a while, there's something here for everyone. Trust me, understanding these strategies can be a game changer for your bottom line. Before we jump in, make sure you hit that like button, subscribe to the channel, and turn on notifications so you don't miss out on any future videos about real estate investing, financial tips, and more. All right, let's get started. Let's kick things off with the foundation of smart tax planning, understanding tax deductions. Now, a tax deduction is basically a legitimate expense that you can subtract from your taxable income. This means you pay less in taxes overall. It's like getting a discount on your tax bill, and who doesn't love a good discount? For small businesses involved in real estate, the list of potential deductions is huge. We're talking about mortgage interest, property taxes, insurance premiums, maintenance costs, utilities, the list goes on. But the key here is to track everything meticulously. Keep those receipts, invoices, and any documentation that proves these expenses. Remember, the IRS is all about proof. If you can't back up your deductions with solid documentation, you might find yourself in hot water during an audit. And trust me, you don't want to go through that. So be organized, stay on top of your record keeping, and don't be afraid to get professional help if you need it. A good accountant can be worth their weight in gold when it comes to maximizing your deductions and minimizing your tax liability. Now let's talk about one of the biggest tax advantages of real estate investing, depreciation. Depreciation allows you to deduct a portion of your rental property's value each year for wear and tear. It's a tax break that recognizes your investment is losing value over time, even if its market value is going up. The IRS sets a depreciation schedule for residential and commercial properties. Residential properties are depreciated over 27.5 years, commercial over 39 years. This means you can take a depreciation deduction every year, lowering your taxable income. For example, a rental property bought for $200,000. Excluding land value, you can depreciate the building itself, say $150,000. Over 27.5 years, that's an annual depreciation deduction of $5,454. This reduces your tax burden significantly. Depreciation is a paper loss, not an actual expense. It reduces your tax liability, freeing up more cash flow for reinvestment. Savvy investors use this tool to build long-term wealth, and you should too. Alright guys, imagine this. You've got a rental property that's appreciated like crazy, and you're thinking of selling. But hold on. Before you do, you need to know about the 1031 exchange. This is a powerful tax strategy that can save you a ton of money. See, when you sell an investment property, you usually have to pay capital gains taxes on the profit. But with a 1031 exchange, you can defer those taxes by rolling the proceeds into a similar property. It's like hitting the pause button on those taxes. Now, here's the catch. You have to follow some strict rules. You've got a limited time frame to identify and close on the new property. and it has to be of like kind. Don't worry though, I'll break it all down for you. The 1031 exchange is a fantastic tool for real estate investors, especially those looking to scale their portfolios without taking a huge tax hit. So if you're thinking of selling an investment property, make sure you do your research on 1031 exchanges. It could save you a small fortune. Let's talk about protecting what you've worked so hard to build. As a real estate investor, you're exposed to certain risks. That's where forming an LLC comes in. An LLC, or limited liability company, acts as a shield between your personal assets and your business dealings. Think of it like this. If someone gets hurt on your rental property and decides to sue, your personal assets like your house or savings could be at risk. But if you have an LLC, they can only go after the assets held within the LLC. It's a crucial layer of protection for any serious real estate investor. Now, setting up an LLC is relatively straightforward and inexpensive. You can do it yourself online or work with a legal professional. Trust me, the peace of mind it provides is priceless. Remember guys, we're not just building wealth here. We're building a secure future. An LLC is a fundamental step in that direction. So make sure you explore this option to safeguard your investments and your financial well-being. All right, everyone. Let's dive into a tax break specifically designed for real estate investors and small business owners, the Qualified Business Income Deduction, or QBI deduction. This deduction allows you to deduct up to 20% of your qualified business income from your taxes, putting more money back in your pocket. Now, to qualify, your real estate business needs to meet certain requirements, such as being structured as a pass-through entity like an LLC or S-Corp. But don't worry, we'll get into the specifics later. The QBI deduction can significantly reduce your tax liability, freeing up more cash flow to reinvest in your business or achieve your financial goals. It's like getting a bonus from the IRS for being a savvy entrepreneur. Remember, maximizing deductions and minimizing your tax burden is crucial for building wealth. The QBI deduction is a powerful tool for real estate investors, so make sure you understand how it works and if you qualify. Alright guys, we're at number 6. On the list of top tax strategies, detailed record keeping. You might be thinking, Graham, this isn't as exciting as a 1031 exchange. And you'd be right, it's not. But trust me, this is the foundation for maximizing those other strategies and avoiding a world of pain come tax season. The IRS doesn't mess around, and neither should you. Think of it like this. Every receipt, every invoice, every mileage log, it's a piece of ammunition in your arsenal to fight for every single deduction you're entitled to. You wouldn't go into a negotiation unprepared, right? Well, tax time is essentially a negotiation with the IRS, and you need to come armed with a fortress of documentation. Now, I know what you're thinking, Graham, I'm busy running a business, I don't have time for this. And I get it. But honestly, with all the apps and software available today, there's really no excuse. You can literally snap a picture of a receipt, categorize it, and boom, you're done. It takes seconds, people. The bottom line is this: detailed record keeping equals maximized deductions, minimized audits, and ultimately more money in your pocket. So do yourself a favor and get organized. Your future self will thank you. Coming in at number 7 is hiring a tax professional. Now, I know some of you are thinking, Graham, I can just do this myself, save some money. If your business is brand new and your taxes are super simple, maybe you can get away with that for a little bit. But as your business grows, you need a qualified professional in your corner. You wouldn't represent yourself in court, would you? Taxes are no different. The tax code is incredibly complex and constantly changing. A good CPA or tax attorney knows all the latest rules, regulations, and deductions. They can help you with tax planning to minimize your tax liability. They'll look at your entire financial picture and come up with a plan to keep more of your money. Hiring a professional costs money, but it's an investment that pays off. They can save you thousands, if not tens of thousands, of dollars in taxes. Wouldn't you rather be out there closing deals than hunched over tax forms? Alright, number 8 on our list is cost segregation. And this one's a hidden gem that a lot of real estate investors, even experienced ones, don't fully utilize. In a nutshell, cost segregation is a powerful strategy that allows you to accelerate depreciation deductions on your rental properties, which can lead to significant tax savings. See, when you buy a rental property, you can't depreciate the entire thing all at once. The IRS has rules about how long you have to depreciate different types of assets. But here's the kicker. Within that building, there are components with shorter depreciation schedules, like appliances, carpet, landscaping, even parts of the building itself. That's where cost segregation comes in. A qualified cost segregation professional will come in and identify all those individual components and their appropriate depreciation schedules. This allows you to take much larger depreciation deductions up front, which means you're reducing your taxable income and keeping more money in your pocket today, not years down the line. Now, cost segregation does involve hiring a professional, but trust me, the potential tax savings can far outweigh the cost. It's particularly beneficial for larger commercial properties, or if you've recently purchased or renovated a property. So, if you're serious about maximizing your real estate investments, cost segregation is definitely a strategy you need to know about. Alright, now let's talk about something that could be especially beneficial for you if you're running your real estate business from home, the home office deduction. Look, I used to work from home all the time, editing videos late into the night, and let me tell you, this deduction can be a game changer. Basically, if you use a dedicated space in your home exclusively and regularly for your business, you might be able to deduct a portion of your home-related expenses. We're talking about things like mortgage interest, property taxes, utilities, even depreciation. The key here is exclusively and regularly. You can't just be checking emails from your couch and call it a home office. It needs to be a designated space, specifically used for your business operations. But if you qualify, this deduction can seriously reduce your taxable income, putting more money back in your pocket to reinvest in your real estate ventures. And as always, make sure you're keeping meticulous records of your expenses. Trust me, it'll make tax time a whole lot easier. Now, let's talk about something nobody really likes to think about, but is absolutely crucial when it comes to real estate investing capital gains taxes. You see, when you sell an investment property for a profit, you're going to owe taxes on that gain. And trust me, those taxes can eat into your profits if you're not careful. But here's the thing, with a little bit of planning, you can minimize those taxes and keep more of your hard-earned money. We're talking about strategies like holding on to your properties for longer to qualify for lower long-term capital gains rates, or even using a 1031 exchange to defer those taxes altogether. Remember, being aware of potential tax liabilities is just as important as finding a good deal. So, plan ahead, explore your options, and make sure you're maximizing your returns while staying on the right side of the IRS. So, there you have it, guys. Those are my top 10 tax strategies for small businesses investing in real estate. Remember, the tax code is complex, and it's always changing, but by understanding these strategies and working with a qualified professional, you can maximize your returns and build that real estate empire you've always dreamed of. For a more in-depth look at each of these strategies, make sure to check out the blog post linked in the description below. It's packed with even more information that will save you money come tax time. As always, thanks for watching. If you found this video helpful, please give it a thumbs up, subscribe to the channel for more content like this, and hit that notification bell so you never miss an upload. Until next time, stay informed, stay focused, and keep crushing it.